While stocks are trying to add to last week's gains, we're not seeing a big relief rally today. Kind of iffy. The S&P Regional Bank Index up about 1% today, but down close to 30% over the past month. So is the coast clear for banks, and what does it mean for the markets in the future? Let's talk markets with Lisa Erickson, head of the Public Markets Group at U.S. Bank Wealth Management. Lisa, welcome. Good to have you with us. You are, in your words, cautious on U.S. equities. Why? What's the biggest factor making you so?
We're really cautious on the back of some tough overall factors, both in the economy as well as what's going on policy-wise. So if we just break it down briefly, when we look at our trend indicators, both across the U.S. as well as globally, what we see is that activity definitely remains muted, and we're not seeing a much pickup month over month in trends. And in addition to that, while inflation has come down to some degree, it still is elevated. And so that's really leading us to that tough spot in terms of policy, where again, Fed officials need to be biased towards tightening, and yet, watching the impact on growth and again, some of the financial stresses that we've had lately.
If I buy your case and want to play cautiously in the markets today, what is a solid, sound way to do that? Is it to go with defensive equities, or is it to tilt more into T-bills and treasuries? What's the more savvy way to do it?
We're really recommending that clients look at a diversified source of cash flowing types of investments. So that would include just their ongoing solid commitment to fixed income, where we have some very nice rates right now offering income. And in addition to that, another category called real assets, which really represent underlying bets on both real estate as well as global infrastructure, sectors that offer very attractive dividend yield and a lot of times more stable ongoing income flows just because of the nature of their businesses.
So, Lisa, you don't think they're going to start cutting rates soon, or it doesn't matter?
So certainly in terms of what may happen in terms of rates, it definitely looks like we're closer to a pause or a pivot, certainly than we were months ago. And so within fixed income, what we really think that means is, while certainly we've got some very attractive rates on the short end of the market, to not just stay too short, but really look at making your maturity structure more close to that of the benchmark, so that if the Fed does again, pause or pivot, you can capture some of that positive price action on the back of such an action.
No, absolutely. It's, short term looks great until all of a sudden your 6-month T-bills mature and you can get half the rate that you once could. Lisa, thanks for joining us today. It's good to see you.